Today we are here to tell you everything you need to know about GameStop in 5 minutes. The story of GameStop is almost unbelievable. It's almost fascinating to see how a movement ignited by a couple of just random Reddit users brought billion-dollar hedge funds down to their knees. People had suffered heavily from the excessive risk the financial institutions had taken in 2008. While the institutions were bailed out, the financial crisis of 2008 left many people in dire circumstances. In 2020, the job losses due to pandemic revived the sentiments against the financial institutions, and the undervalued stock of GameStop happened to be just the weapon for the investors to get back to the institutions. This is what we will be sharing today. First, what happened, what is short selling, about short squeeze, then why is this significant, then something on financial democratization. So let's get started. So what happened? GameStop had been making losses and hedge funds had held short position on 84% of its stocks. With publicly available information about the short position of hedge funds and the undervalued nature of the stock, people started buying GameStop in huge numbers, which increased the demand of the stock and jacked up its price by over 1700% just in few days. Just imagine, prominent hedge funds like Melvin Capital lost 50% of its funds worth, losing about $13 billion. At this point of time, you must be wondering what exactly is short selling. Short selling essentially means betting against price increase of the stock. Let's try to understand this with an example. Let's say a short seller borrows 10 stock from an institution and sells it at a market price of $500 with an anticipation that the prices will fall. Now let's say the price share falls down to $400 and short seller buys back the stock, give it back to the institution along with the interest and pocket the remaining difference. Now, given that you have understood how short selling works, you realize that fall in market price of stock is crucial for a short seller to make a profit. Now, what happens when the stock price, instead of falling, reaches astronomically high levels? In a frenzy, the traders who had bet that the stock price will fall now have to buy the stock to return to the owner to control further losses. In case of GameStop, short sellers lost $301 per share as they had to buy back the stock and give back to the owner. This scenario is called a short squeeze. Now, why is this significant, you may ask? Actually, this has fundamentally changed the investment philosophy of the investors, where instead of betting on the fall of the stock prices of the companies in question, the investors are now willing to invest in stock of companies that show a promise of high growth. And where does this lead us? I believe this leads us to a situation of financial democratization, where more and more people are encouraged to invest due to rise of zero commission trading apps. GameStop example also raises serious question on how an influential figure or a group of people can impact demand of a stock and push up the prices. At the end of the day, we all should keep in mind that this trading is a zero-sum game. Every dollar that a short seller gains is a dollar lost from someone else's pocket. So see you guys later. I hope you get an idea of what's going on with the GameStop. Thank you.